Hi there, this is Alvin from Dr. Wealth. Today we're not going to talk about the stock market. We're going to talk about savings account. The reason is because interest rate has been rising and a lot of people are getting interested to earn that extra yield on their idling cash. So if you are someone like that, be sure to watch this video. We will cover fixed deposit, savings account, bonds, bills, and whatnot, so you can find the best place to park your money. Everywhere has a pros and cons, and you should consider your context where it is best for you. And this is only for those living in Singapore, right? Because the products are only available here. So with that aside, let's go on to the very first product, and I would say that is the savings account. And an interesting thing is that OCBC really jacked up the interest rate and caught the market by surprise. And I must say the interest rate is really mouth-watering. And what do I mean by that? Let me blow this up for you. So this is a screenshot taken from OCBC bank account, the 360 bank account. Okay, and the base rate is not very high, it's just 0.05%. So nowadays, a lot of banks offer this kind of hurdle accounts where you have to achieve certain activities with the bank, then they will give you more interest rate. But this is not difficult to achieve because if you just take a look, if you credit your salary into the 360 account plus you save $500 a month, you will get a maximum effective interest rate of 4.05% a year. That is higher than even your CPF essay, that's higher than your bond yields, that's higher than your fixed deposit rate. And this is a savings account where your funds are very liquid. So you can see what I mean by very mouth-watering kind of returns. And of course, the more you do, the more you get in terms of the interest rate. And if you do everything, you can get a maximum effective interest rate of 7.65% a year. That is really, really very high, right? So I would say that OCBC really spoiled market with this 360 account interest rate changes. And if you are someone who is able to qualify some of these things, all right, the hurdles, this is something that you should really consider. Of course, let's talk about the advantages and disadvantages, right? Every place where you can park your cash have these pros and cons, okay? It's important to know, and then you can really see which is the best for your context. So as I said, the funds are very liquid in this savings account, right? And the hurdles are not difficult to achieve, and the interest rate are very attractive, okay? So these are the advantages of 360 account. And the disadvantage, I would say that the first is the need to credit salary, so which means for certain people like retirees where don't have a source of income, they would automatically be disqualified from this higher interest rate. So they will only earn the base rate, which is 0.05%. Okay, so if you cannot credit your salary, this is not for you. And the second thing is that there's also a cap of $100,000, right? Which means that if you have more cash that you want to get higher interest, you can only get up to $100,000. So you still need to deploy the excess capital or excess cash elsewhere. Okay, so you can see it is not perfect. Okay, it's only good for a certain group of people. Let's move on to the next one. And of course, the next thing that people think about when it comes to savings account with the bank is that, oh, why don't we get a fixed D that can increase our interest rate further? And this is the top three, right? Interest rate in terms of a fixed deposit in Singapore, updated in November 2022. We see that the highest that is offered by banks is CIMB, which is at 3.9%. Tenure is over 18 months. Okay, minimum deposit of $10,000. And you can see the next one is Bank of China at 3.45%, and the third one is RHB at 3.4%. Okay, so these are Sing dollar deposit. Okay, another advantage of this fixed deposit is that if you have excess foreign denominated currency, you can put in fixed deposit, and this feature is usually not available in other kind of savings account or bonds or bills in that context. So let's talk about some of the advantages, right? I mentioned about foreign currency deposits already. Okay, so the other thing is that the rates have generally risen, right? If you compare the rates in November, it's definitely higher than the previous months. Okay, so there is a tendency that these rates can continue to increase as long as the rate hikes continue. There are disadvantages. First is that you can see the quantum is higher, right? The minimum deposit is like $10,000, $5,000, $20,000. It is unlike savings account, which we mentioned just now. There is no minimum. Okay, as long as you qualify, you will be able to get those higher interest rate on the very first dollar. And even for bonds or bills, they are like $500, $1,000 minimum, right? Which is still a lot smaller compared to a fixed deposit requirement. And the second is that you can see the lock-in period is longer, right? Savings account, there's no such thing as a lock-in period, but for fixed deposit, you need to commit to that entire period and not withdraw your money prematurely. If you do so, you will have to pay certain penalties. We actually compiled a report on this list, a long list of these fixed deposits, the various rates, the various tenures, and the various conditions, terms and conditions. Okay, so if you're interested to really look at this fixed deposit report, I've pasted the link in the description and you can click on it and you can download this for free. Next up, we have this Singapore Savings Bonds, and in short called SSB. So this is issued by the Singapore government, and which means it's AAA rated, very highly credible. And this is at a 3.47%, and that is if you hold over the 10-year period. Average each year you get 3.47%. So this has also risen, right? Just a year ago is probably like 2% or even lower. The advantages of this SSB is that it's also liquid. Okay, first of all, yes, you talk about 10 years, you get this average of 3.47%. But if let's say next month you decided, oh, there's a better place to park my cash and I want to withdraw, or you wanted to use this capital to buy in the stock market, you can easily redeem this. There is no lock-in period and there is no capital loss. Okay, so this SSB is very unique in the sense that it doesn't fluctuate in terms of its price. It's always fixed at par. So regardless how the interest rate move, this bond will always trade at par value. So which means you don't need to worry, even as interest rate goes up, the bond price doesn't fall. And you can always take back your capital, just that you don't enjoy the interest over time, right? And the disadvantages is that it's a step-up interest. That means that you look at it, it's 3.47%. But let's say you hold for 1 year and you decide to redeem it, you actually don't get 3.47%. The first year is written, let me just blow this up, is written there at 3.26%. Okay, so your first year is lower, okay, than the 3.47%. And each year, as you hold longer, the interest get higher and higher and higher, to the point that you average over 10 years is 3.47%. Okay, so this is something that you must take note of. Okay, so if you decided to hold less than the 10-year tenure, your interest rate is actually lower than this 3.47%. And there's also a cap of $200,000. Likewise, if you have a lot more capital or cash that you want to invest, you can only do up to $200,000, and the remainder you have to find somewhere else to park. From the SSB, we move on to the Singapore government bills and bonds. The issuer is still the same, and we have different tenures. As the bills are 6 months or 12 months. Okay, so those are called the treasury bills, and the treasury bills is slightly different from how the bonds work. Okay, so the bonds tenure are usually from 2 years to up to 50 years, so it's a lot longer. Besides the tenure, the bills don't pay an interest. So what they do is that you bid for it, right? The par value is $100, but when they decided where the cutoff yield is, you actually get a refund of your capital. Maybe it's $96, right? So they refund you $4 for every bond. And then when you hold the bill until the maturity date, they will return you that $100 for every bond that you have. So you can see that the discount is given to you at the start and there's no interest payment, but at the end of the day, they'll pay you more than what you put in. So that is where that return comes in. For bonds, it's different. For bonds, they will actually pay you a half-yearly interest for this Singapore government bond. So every 6 months, they'll pay you interest. Okay, you buy at par, you will redeem at par. So $100 per bond when you buy, and you'll get back $100 per bond at maturity. Okay, so that is the key difference between the bills and the bonds. And if you take a look right now, the interesting thing is that the yield curve has inverted. That means that the shorter tenure bills and the bonds are at higher interest rate compared to the longer dated ones. Okay, so if you ask me, definitely as a savvy saver depositor, you definitely want to leverage on a higher yield, right? And the lockup period is not as long. Okay, so at about now 6 months bill is at 3.96% yield. So after 6 months, you can buy another bill, right? And you just keep rolling over. But of course, there is a risk. If the interest rate falls 6 months later, you will not get this 3.96% anymore, right? It will be lower and lower and lower. If let's say the long-term bond yield, let's say a 20-year bond, 30-year bond, or 10-year bond yield has gone up to like 4 or 5%, and you find that it's very attractive for a AAA rated issuer, you might want to lock the bond yield for a longer period, right? If you can lock a Singapore government bond for 5% for the next 10, 20 years, I think that is really quite attractive, right? For a safe part of your investment. So that has not happened yet, and I don't think that such long-term bonds are very attractive at this point in time. So definitely the short-term treasury bills looks a lot more attractive. And we should not forget that we can also top up to our CPF special account. Yes, interest rate has been rising and CPF rates have not increased at this point in time, but the CPF special account is still very generous in giving that 4% interest rate. And there is a chance that this interest rate may revise upwards if the bond yield continue to rise over the 12-month period. A key benefit of topping up your CPF SA is that you get this tax relief. right? So it's not just making your cash work harder, but you also get some tax benefit, and you pay less tax, means more money back to your pocket. And second is that the 4% interest rate remains one of the highest and stable. Okay, if we look at some of the savings options out there, right, fixed D is not 4% yet, SSB is not 4% yet, and the bills, the bonds are not 4% yet. So you can say that the CPF SA 4% interest rate is still more attractive than a lot of options out there. Of course, there's one big concern, is that once you top up, it's a one-way street. Okay, you cannot take it out anymore. And some don't like their money to be locked up, right? Then this is not an option. But some may think that, oh, I don't need this money, right? Until I retire, I'm not going to touch it anyway, right? So it might not be a bad option if you are very, very clear that is how you want to sock your cash away, right? That CPF SA would be a very good option. Okay, but there are disadvantages, right? So we mentioned about one, which is the lockup. The second is that you can't get tax relief after $16,000. Okay, and that's it. All right, which is quite a low amount for those who have a lot of cash lying around. Okay, so this is a busy table. I try to think of many different contexts, right, different conditions, and hopefully this table can help you narrow down which is the best place to park your money. So let me blow this up for you. So let's look at the first column, which is liquidity, right? So we can definitely say that savings account, Singapore savings bonds, and Singapore government bills generally have quite high liquidity, right? Bills, yes, you got 6 months and 12 months lockup period, but I think within a year is still considered pretty liquid. And Singapore savings bonds can be liquidated in the next month. Okay, savings account, definitely you can tap on it anytime. Fixed deposit, I put a yes and a no, because fixed deposit, they are 6 months, 12 months, and then they are over like 24 months kind of tenure. So it depends on the tenure they're looking at. And Singapore government bonds, definitely liquidity is not there. Yes, you can sell the bonds in the secondary market, trade on the SGX, but it doesn't mean that you will be able to sell at the price at par value. Sometimes you might even sell below the par value. So there is some interest rate risk over there. So I would think that if you want to buy a Singapore government bonds, you want to hold till maturity, which usually is longer term. And lastly, CPF SA top up, definitely there's no liquidity to talk about. And in terms of the second column, the little to no condition is that likely the savings account is the one that is losing out compared to the rest of the options. Okay, because the savings account, you want to get higher interest, usually you will need to complete certain hurdles. Otherwise, you don't. The base rate is very low at 0.05%. The rest of the accounts don't have this problem. Third, locking in good long-term rates. Okay, this is what I mentioned just now, right? So some of you might not need the cash in the near term or in the next few years, and you want to take opportunity of this higher interest rate environment to lock in a good rates in case the interest rate come down in the future, right? So if that is the case, those longer period bonds would have a better way of locking in these good long-term rates. As CPF SA, definitely, right? Minimum 4%, it can even go higher. And Singapore government bonds, right? If, like what I mentioned just now, if you go to 5%, I think it can be very attractive for people to lock 10 years, 20 years for the interest rate. Singapore savings bond naturally is 10 years, right? It's step up interest. So you can hold on to the bond if you think that the rates are really that good. Okay. For the rest of the options, no, right? Because they are shorter term in nature. And in terms of tax relief, only CPF SA top up qualifies. Okay. In terms of low minimum, fixed deposit is the one that is the odd one out, right? Because the rest of the options will only require a very small amount, $500 or even a $1. Okay, you want to top up $1 for CPF, you want to save $1 in your savings account, it's also possible. But fixed deposit, usually it needs a lot more quantum. And in terms of high maximum, there is a mix, right? Savings account, usually you only enjoy the higher interest for the first 100,000. For Singapore savings bond, only up to 200,000, and for CPF SA top up for tax relief, there's 16,000. There's also an annual limit, right, of I think about 30 over thousand. And lastly, foreign currency, very obvious, only fixed D is the one. The rest are all in Sing dollar, and so if you have USD lying around, some of the fixed D are giving very good rates for USD deposits as well. Okay, so these are the pros and cons. I hope this table can help you narrow down, right, which factor is more important to you, and the more ticks it is, that is your choice. Okay, so in summary, I would like to give you some of my opinion, okay, give you more context. Okay, so if let's say you receive a salary, you can save and you can spend with OCBC, then this OCBC 360 would be your best bet. So if you don't have a salary, actually treasury bills would be a very good option to store your money, right? Because the interest rate is still higher than fixed D, and you get the liquidity and you just keep rolling over. And third is the fixed deposit is best for those foreign currency, right? Because you can't really park foreign currency in a lot of other options. So that is your best option for you to look at. And lastly, if you really don't need the cash till you retire and you want to get some tax relief, then CPF SA might be the best choice. And just to conclude, you don't need to just choose one option. Okay, if you really have a lot of cash lying around, you can actually spread around, right? Because you have a lot of these higher interest rate accounts and options that you can tap on. For example, you can do your CPF SA top up, and on top of that, you can have a 360 account, right, to earn that extra interest. And on top of that, you can still buy some treasury bills, right, or even SSBs. Okay, so it can be a combination of options. It doesn't need to be just one of it. So hopefully this video have give you a good idea where to park your money. So please like this video and subscribe to our channel. Thank you for watching. Goodbye.